is meant to be for year one. So year one, you can see 4,300 is 4,300. So 1 minus 0.3. So this one we have already calculated as 400. You see the 400,000. So me, I will be using 400 because I have left 3 zeros at the top for this one. So get now the value for year one. Then we go to year two. We go to year two. Year two, it will be 3290. 3290. 1 minus 0.3. Also add the 400 you get for that. The same case for year three. So year three, it is also supposed to be 3200. Then 1 minus 0.3. Also add the 400 like this. The next one is meant to be year four. So year four, it is 3700. 3700. We also add the 400 like this. For year five, it's also going to be 4850.
So this one maybe 85 out of 1 multiplied by 4 plus out of 1 times 3. And 3. So that is the answer. Equals 6, 2, 5, 6. WACMR. WACMR. B. Weight of T1 becomes revenue contribution by ratio of 1 plus weight of T2 becomes revenue contribution by ratio of 2. This one we know is
so after that, now we can get the payback period also for this one. The same way we have done the other one. The same way we had the other one. So what we do for that, we want to get the payback period. The payback period. So what we do, we shall be having the year, the cash flows, present value interest factor. Present value interest factor. You remember the cost of capital was 12%. 12%. Present value interest factor 12% for each year. So that we come up with the present value, also the total present value, also the total present value, like that. Year 1, 2, 3, 4, year 5, up to year 6. So year 1 cash flows were how much? 2410. Then year 2, 30, 2703. 2703. How about year 3? 2640. Year 4. 2990. Year 5. 47. 47. Year 6 itakuwa 34. 94. Na tumeelewana tuna add nini? 825. So itakuja ngapi?
Now the next thing is the expected profits.
So 30. 43. 19. So nakumbuka how to take the tables, multiply and also get the total. Then what was the total? Do we complete the present value for cash outflow? The total initial investment was, and then when you add, yeah, so do the same like that, and then get when did you recover that money, so that we get the payback. The same way you have done the other question. Working capital was the same for both.
Then the fixed cost is 450,000. If you are looking for profits, you're looking for profits. When you are purchasing 1 shillings. Profit is given as W is in half. W is half. Look at market revenue minus F. Sasa hii W is in half. You already have something that I can 0.9. And then the revenue in this one, so 1,280,000 minus fixed cost, which you know is 450,000. What's that? There's a small difference that you here. Next thing that you can use the difference is when we say in it's simply a matter of fact most likely so most ones are talking about if you go to our area, they will not tell you how many days we have sat. They will tell you how now. Therefore, from the other side, we need to have other copy. So that is if you don't know that. But whichever account was supposed to have one. So that is the same way to the when you go to my so now we have more this, but now it's not but now we know this. That's more. That's why we know this yet. Next thing that we need to know how to commit is making points. how you show is now to show it on the play and show you what I want to do where you tell us total constitution. And there's the now you use the old lines. Maybe we shall have a so break-even points are units, X, E, even at so this one comes cost is 400,000 divided by WS here equal 3.6 by 6. Let's now compute the break-even point series. Break-even point change RE is given as F divided by WACR. So sasa hii itakuwa 400 divided by our WACR of 0.392. So the answer will be checked. The next thing that we need to get is called standard deviation. Standard deviation of the profits. So this one, because the formula is different, standard deviation of the profit of 1 and 2 is equal to the contribution margin of T1 squared multiplied by variance of sales of T1 plus contribution margin of T2 squared multiplied by variance of sales of T2 plus 2 contribution margin of 1 contribution margin of T2 standard deviation of sales of T1 standard deviation of sales of T2 correlation coefficient between sales of T1 and sales of T2. There are all these together raised power half. Let us now record this. Contribution margin of 1. Najua it is 4. So it is 4 squared. And sales of T1 Napiwa, the starting division for now 8,000. We also know that for you to get balance, you square the contribution margin square B. Then you multiply by the variance, and the variance is the starting division of 5,000 square. Then you say plus 2 times 4 times 3 times the third division, which is 8,000 times 5,000 times the correlation coefficient. The correlation coefficient therefore is minus 0.9. The whole of this you get is around.
So which one should you select? The one with the shorter payback period. So it is between year 4 and it is between year 3 and year 4. So normally we pick the one with the shorter payback period. So that means that we select project what? Alpha. So the advice is that select project alpha, since it has a shorter payback period. You select project alpha since it has a shorter payback period. So that is now in relation to that question. The one for the last sitting, it was just the normal payback period, not the discounted payback period. And that one we did under the normal non-discounting technique. So that is all about the discounted payback period technique. So let us now go to the next technique, which should be now number 3, as the net present value. We've got the net present value. We started with the first one we discussed was modified internal rate of return, isn't it? Yeah, now that was the second one. So we got number 3 as the net present value. We got number 3 as the net present value technique. The net present value technique. We got the technique number 3 as the net present value technique. As the net present value technique. So your payback period umepata 3.92. Yeah, they are confirming that the payback period was 3.92. So let us now have something brief on the net present value. So under the net present value, we simplify that it is a discounting technique. NPV, we write that it is a discounting technique. It is a discounting technique. It is a discounting technique which is used to evaluate the projects. It is a discounting technique which is used to evaluate the projects. It is a discounting technique which is used to evaluate the projects. And it is calculated as follows. and it is calculated as follows. Is calculated as follows. So NPV is supposed to be equal to NPV is supposed to be given by present value for the cash inflows minus the present value for the cash outflows. So NPV will be given by present value for the cash inflows. We minus present value for the cash outflow. Then we add there a paragraph by noting that the decision will be made as follows. The decision will be made as follows. The decision will be made as follows. So the first dash, we write that if NPV is positive, if NPV is positive, if NPV is positive, then accept the project. If NPV is positive, then accept the project. If NPV is positive, then accept the project. The second dash is that if NPV is negative, if NPV is negative, then reject the project. If NPV is negative, then reject the project. Then reject the project. Then the next one is that if NPV is equal to 0, if NPV is equal to 0, then we can either accept or reject the project. If NPV is equal to 0, then we can either accept or reject the project. We can either accept or reject the project. So the first question I want us to check on, there is the question for May 2021, question number 1, part B. May 2021, there is a question number 1, part B. May 2021, there is a question number 1, part B. May 2021, there is a question number 1, part B. May 2021. May 2021, there is a question number 1, part B. May 2021, there is a question number 1, part B. So May 2021, question 1, part B. The question reads that Nyakati Limited intends to invest in a 4-year project. So Nyakati Limited intends to invest in a 4-year main project whose initial outlay is how much? That's 32 million. Yeah, so the project is expected to generate the following cash flows at the end of each year. The following cash flows at the end of each year. So they gave you the year 1, 2, 3 up to year 4. So the cost of capital has been given as 12%. So required, advise the management whether to undertake the project using the IRR. So before you calculate the IRR, you must first calculate the NPV. So I will first calculate the NPV. When we go to the IRR technique, we shall still go back to the same. So I want us to get the NPV of that project. I want us to see how to calculate the net present value of that particular project. How to compute the net present value of the project. So NPV is supposed to be given by present value for the cash inflows. We minus the present value for the cash outflows. So we start with the present value for the cash inflows. So to get the present value for the cash inflows, there will be the year, then also the cash flows, present value interest factor, present value interest factor. The cost of capital has been given as 12% for each year, so that we come up with the present value portion. We come up with the present value for that portion. So there is year 1, year 2, year 3, up to year 4. So year 1, it is 12,000. Year 2, 15,000. Year 3, it is 9,000. Year 4, it is 6,000. So 12% year 1, 12% for year 1, it was which year? 0.8 after 9. 2.9. Then year 2, it is 0.7. Then year 3. And finally 0.6355. So multiply this by this, we get this present values. Then you add them together. That is what will give you present value for the cash inflows. That is what will give you the present value for the cash inflows. So that is what will give you the present value for the cash inflows. Give you the present value for the cash inflows.
The question is asking the point. Let's now write the formula for break-even point. Break-even point. Given points of units. How do we get this? Know the formula. SBE, when we are in multiple, is F right W that is the case. How do we get WACM? WACM is the way we have two products here. And here, so in the way of E, use the margin of A plus B, plus the weight of A, use the margin of A. Next question that comes up here is how do we get contribution margin? Price minus variable. The other thing is that we now start identifying and in identifying the contribution margin of B, the examiner has said Solution value of A, examiner of challenge what? So we need now this way to be clear of which looks like.
So, what are we getting as the total present value for the cash inflows? We are getting 32, 892. So, you are supposed to minus present value for the cash outflow. So, present value for the cash outflow will be the same as the initial cost. You can see what you are given in the first paragraph. That initial cost was 30 what? So you take 32, when you subtract, you will now be able to get the NPV, which is 892. So that NPV is positive. So if you are to advise, you advise them to accept the project. If you are to advise them to accept the project, since the NPV is positive, you advise them to accept the project, since the NPV is positive. The NPV is positive. So I want us to get another question still on how we can also calculate. Also see how we can be able to calculate the NPV. So the next question . So the next question I want us also to check, November 2015, question number 3, part B. November 2015, question number 3, part B. November 2015, question 3, part B. November 2015, question number 3, part B. Check November. November 2015, question 3, part B. So mine is on page 69. I don't know on your side. Any comments? So are we all able to see the question? Yeah, question 3, part B, where they say that the following details relate to the capital project in the XYZ Limited. In the XYZ Limited, whereby project cost, they gave you 65 million. Then annual cash flows is 21 million. So the project economic life is 5 years. Required rate of return is 20. So I want to do that question because cash flows are the same every year. This one, they were different. But this one, they are the same every year for the 5 years. The cost of capital has been given as 12%, the same that we have here. So required, they wanted you to compute IRR and the profitability index. But still, before you calculate that IRR, you will have calculated the NPV. So let us see how to get the NPV of that question, because cash flows are the same every year for a given period of time. Cash flows are the same every year for a given given or made. So to compute the NPV, NPV is supposed to be equal to present value for the cash inflows minus the present value for the cash outflows. So present value for the cash inflows, it will be annuity multiplied by present value interest factor for the annuity. The cost of capital or required rate of return is 12%. Is 12% for 5 years. So that annuity is what you are given as the annual cash flows after tax. They gave you 21 millions. They gave you 21 millions. So I would like you to check in the second table. When cash flows are the same every year, you normally use the second table. So check 12% in year 5, the second table. 12% in year 5, the second table. So what figure do you have? 3.6048. Now you yes. Present value for the cash outflows. For present value for the cash outflows, we shall be able to get the initial cost. The project will cost 65 millions. So you subtract the 65 millions. That was meant to be the initial cost, so that we get the NPV. So that we get the NPV for that portion.
Now this one will come in March when you agree on.
So that should give us now the net present value. It will either be positive, it is either positive, or if it is negative, we reject. If it is positive, we accept.
So now we get the rates.
Is it positive or negative? Yeah, so if it is positive, you advise them to accept the project. Accept the project because NPV is positive. Accept the project because the NPV is positive. You accept the project because the NPV is positive. So I want us also to check another question. So this one should be May 2014. May 2014. May 2014. Question number 1, part B. May 2014. We check question number 1, part B. Check May 2014. So I will start with the part A. You can see part A of the same question. They were asking to explain 4 features of ideal investment appraisal method. What are the key features of the ideal investment appraisal method? So first, let us outline the key features. The features of, we can now look at the features. We can look at the features of ideal investment appraisal method. Ideal investment appraisal method. We look at the key features of the ideal investment appraisal method. So among the key features, the question I said you check May 2014 question 1. May 2014, question number 1.
I divided by 130.
May 2014, question number 1. We have said we start with part A, where we want to explain what are the main features of the ideal investment appraisal method. So one of the key features, number 1, is that it should take into account the concept of the time value of money. It should take into account the concept of the time value of money. It should take into account the concept of the time value of money by computing the present value of the cash flows. By computing the present value of the cash flows. By computing the present value of the cash flows. By computing the present value of the cash flows. The number 2 is that it should use cash flows. It should use the cash flows. It should use the cash flows and not the accounting profits. It should use the cash flows and not the accounting profits and not the accounting profits when evaluating the projects. It should use the cash flows and not the accounting profits when evaluating the projects. When evaluating the projects. Number 3 is that it should be able to give the decision. It should be able to give the decision in case of one project. It should be able to give the decision in case of one project. Instead, in case of one project. Like now for this one, you have seen when it is positive, you accept. When it is negative, you do what? You reject. So you can give a decision even when the project is just one. The last one is that it should use all the cash flows of the project. It should use all the cash flows of the project. It should use all the cash flows of the project. It should use all the cash flows of the project. When evaluating the project, it should use all the cash flows of the project. When evaluating the project. So that is now just part of the required, but when you'll be looking at advantages of the NPV, you will get more others. Because those advantages for the NPV will be those ideal techniques or their features. So let us now go to part B of that same question. So part B, you are being asked that Kiwanda Limited is considering the launch of a new product M, for which an investment of 6 million in the plant and the machinery will be required. Plant and the machinery will be required. The production of M is expected to last for 5 years, after which the plant and the machinery will be sold for shillings 1.5 million. It will be sold for shillings 1.5 million. So additional information, not number 1, M will be sold at 600 per unit with a variable cost of how much per unit? 240. Not number 2, fixed production cost excluding depreciation will amount to 600,000 per annum. Not number 3, the company will apply the straight line method of depreciation. The company will apply the straight line method of depreciation. Not number 4, the cost of capital is 10% per annum. Not number 5, number of the units of M expected to be produced and sold per annum for the next 5 years is shown below. So they have given the year from year 1 up to year 5. Then unit expected to be produced and sold was also given. the corporate tax rate is given as 13%. So now required, advise the management on the appropriate course of action using Roman letter 1, net present value, Roman letter 2, internal rate of return. So always before you calculate IRR, you must first get the NPV. So previous questions you have done, they were able to give you the cash flows, but this one has not given us the cash flows. So the starting point is to prepare the cash flow statement. Prepare the cash flow statement so that we come up with prepare the cash flow statement. Prepare the cash flow statement. We should come up.
So, you already know how
prepare the cash flow statement. So in our cash flow statement, we shall be having year 1, year 2, year 3, year 4, and also year 5. Because the project was supposed to be there for 5 years. So I will reduce the figures by 3 zeros. I will put 3 zeros at the top. I put 3 zeros at the top. So we start with the sales revenue. We start off with the sales. Start off with the sales. So when it comes to the sales, I want you to go to the note number 1. Are you able to see note 1? They will be sold at how much per unit? Then when you go to the note number 5, are you able to see note 5? The number of the units M is expected to be produced and sold per annum for the next 5 years is shown below. So year 1, it is 8,000. So when you take 8,000 multiplied by 600, how much will be the sales for year 1? Sorry? 4.8 million. Then we do the same for year 2. Year 2, it is meant to be 7,000, also multiplied by what? 600, which is supposed to be 4.2 million. Year 3, it is also the same as expected. How about year 4? Sorry. But why? You multiply 5,000 units by 600. How about year 5? That's 1,800. So that is now for the sales. Then we less variable costs. We less variable costs. We less variable costs. So go back to the note number 1. Are you able to check in the note 1? Where they say that variable cost will be how much per unit? 240. So you go back to year 1 in the note number 5. You see the 8,000 units multiplied by 240. That will give us how much? So this will be 1920. How about year 2? Year 2 is 1680. So even this one will be 1680. Year 3 should be which year? Year 4, sorry.
What shall we do in one?
7. 1200. How about year 5?
So contribution ratio
Year 5, 720. Then we also less the fixed costs. Also less the fixed costs. Also subtract the fixed costs. Also less the fixed costs. So fixed costs were given to you. When you go to the note number 2, fixed production cost excluding depreciation will amount to how much per annum? So we record the 600,000 every year because it's per annum. So when we subtract those two items from the sales revenue, we come up with we should be able to get earnings before depreciation and the tax. Get the earnings before depreciation and the tax. Earnings before depreciation and the tax. So what is there for year 1? Year 2 should be which figure? So this is also 1920. How about year 4? That little of yes. Yeah, we should negative what? I'm on positive. So that is now our earnings before depreciation and tax. So we minus depreciation. Now less the depreciation. So depreciation should be on the straight line basis. So when you check over in the first paragraph, they say that they were meant to invest 6 million in the plant and the machinery, and the M was supposed to last for how many years? And the salvage value would be 1.5. So we use the straight line method to calculate depreciation. When you use the straight line method, take the 6 millions minus the salvage value, which is 1.5 millions, divide by the 5 years. That should give you the depreciation per annum, because we apply the straight line method. When you check in the first paragraph, it was costing 6 million, but they can resell it at 1.5 million. It is supposed to be there for 5 years. So what should be the depreciation per annum? Sorry, 0.9. So I will be using 900 because there are 3 zeros at the top. So it is the same every year. 900,000. 900,000. So we subtract to get the earnings before the tax. We subtract the depreciation so that we get the earnings before the tax. So that we come up with the earnings before the tax.
Now, in the proposed means, the revenue for B.
So, how much is there for year 1? 13. How about year 2? 20. So also this one is 1020. This one is 300. Are you giving me negative what? So now we less the tax. Now less the tax. Less the tax. So the tax was 40%. 30%. So what is 30% of 1380? What would be 13% of 1380? 414. Then for year 2, 306. Also, you can 306. Now, you get a point. 98 tax. We don't pay tax on the loss. You just put there a dash. So this one has no tax. So you subtract to get earnings after the tax. So you get the earnings after the tax. So you get the earnings after the tax. So year 1 will be how much? 966. Year 2. Sorry. This is 14. 714. If you have 714. Now you can get 200 and you get about -420. So we add back a depreciation. Depreciation is not an actual outflow of cash. It is simply a provision to reduce the taxable income. Mnakumbuka the other formula tulikuwa tunatumia? It was depreciation more by the tax, but we are adding back, isn't it? Yeah, so the reason why we depreciate is to reduce the taxable income, but it is not an actual outflow of cash. Once you have taxed, we normally add it back so that we reduce the taxable income. So we add back the depreciation. There are 2 items which will be adding back. So we shall be adding. So we add the 900. So the other item you will add is the salvage value. We also add the salvage value. So this question has no working capital, but we have also been added over there. So you remember our salvage value. When you are calculating depreciation, you remember the 1.5 millions? Yeah, so that figure is recovered. You add it back as a cash inflow in the last year of the economic life of the machine, so that we get now the annual cash inflows. So that we get the annual cash inflows. So year 1 itakuwa ngapi? Get the figure of 1866. So year 2 should give us which value? 1614. Also 1614. This one is 19 hours. So we have everything. Yeah, so those are now the annual cash inflows. Those will now give you the annual cash inflows, which we are going to use now to get the NPV. We are now going to use those figures in order to come up with the NPV. In order to come up with NPV. So to calculate now our NPV. So NPV is supposed to be given by present value for the cash inflows. We minus the present value for the cash outflows. So you will be having the year, then cash flows, then present value interest factor. So cost of capital for this question you are given which 10%. We have been given 10% for each year so that you get the present value. So I had reduced them by 3 figures. I had reduced those figures by 3. So year 1, 2, 3, 4, up to year 5. So year 1 it is 1866. 1866. There is 16, 14. Also 16, 14. There is 11, 10. There is 19, 18. Like that. So you check in the first table because cash flows are not the same. So when you go to the first table, 10% in year 1.
So we
0.909. 1. How about year 2? 0.8. Then year 3. 7.5. 1, 3. How about year 4? 6, 8. Then year 5. 5, 9. How about those figures? Which one? 0.6209. So you multiply these figures by these values so that you get the present values. Get those present values. So when you get those present values, you will add them together. You will add them together. So that you get the present value of the cash inflows. Present value for the cash inflows. Then we minus the present value for the cash outflows. Remember, present value for the cash outflow is your initial cost. And remember, it was how much? 6 million. So you'll be subtracting the 6 millions so that you get the NPV. So that was how it was meant to be. So if NPV will be positive, the project will be accepted. But if it is negative, it will be rejected. So that is now for the question. I want us to stop there for now. Last week, we won a class 9 on Saturday afternoon. And last week, we were free. So we shall meet at 2 to do some other questions. So we can stop there, but we still have another class at 2. So when we meet at 2,